Okay. Hi there, everybody. Welcome to this month's Inside the Pro Studio. We are talking about mortgages, housing issues. We'll get into what these photos all mean in our background in a second, but we're going to be talking about mortgages in the crazy world that credit unions are existing in right now with that. Joining me today, I have three incredible people. First up is CU Times executive editor Natasha Chilingarian. Uh, and as I introduce you, I guess I should say, Natasha, quickly, each person tell me what house is in your background.
All right, so hello everyone. I am featuring the house from the show Breaking Bad in
Yep.
Albuquerque. So we were
Very,
thinking about what are our favorite TV movie houses.
yep.
Um, Great show, so had to go with this one.
Excellent. Great choice. Thank you, Natasha. Also joining us today is senior economics reporter Jim Duplessis in South Carolina. Jim, tell me about your house.
Adam's family. I don't need
Adam's
to say
family.
anymore.
Okay, fantastic. A few words. Finally, our very, very, very special guest today is JC San Pedro. He is Chief Lending Officer at Amplify Credit Union down in Austin, Texas. JC, great to see you. Tell me, what is this house behind you?
It is the famous Golden Girls house.
Great choice. Wait, what character do you associate with? Like Blanche?
Oh, definitely Sophia.
Sophia.
Yeah.
Okay. I love this. This is a big psychological experiment here. Okay, we're going to get into mortgage stuff. JC, again, I'm glad you're here. By the way, mine is the Amityville Horror House. Great movie if you haven't revisited that original one. What was it, 77, 78? Great movie. Anyway, today we're doing things a little bit different than we normally do. While we're having our discussion with all of us here, we're going to treat this and try to treat this a bit like a radio call-in show. Now, if you don't know what a radio call-in show is, we have a bigger generational divide than I thought. So I don't know what to say about that. But we have a number of topics that we want to discuss, but the conversation is really driven by our audience. So we're glad everybody's here. So here's the thing. Our audience, you can either submit a question down in the Q&A widget there on the bottom, and I will see it as soon as it comes in. Yes, it's right there. Or, and I'll give you and your organization a shout out, or you can raise your hand and I can unmute you so you can ask your question. So whatever you want. I can see everything happening and, just want you all to enjoy the show and involve yourselves in the conversation if you think of anything. So, with that, the mortgage market remains one of the most challenging areas for credit unions right now. And that's why we have JC on here. But rates remain elevated, affordability is difficult, inventory is constrained, and refinance activity is fluctuating a bit. So mortgage lending, though, remains really one of the largest and most important relationship kind of areas that credit unions have with the member. So let's talk about where we are, where we're headed. Jim, I want to start with you here, just to kind of, you spent the last several weeks uh, digging into mortgage data for our most recent executive briefing. If you had to summarize the current market environment in 1 minute, how would you do that?
Well, I say, first of all, you don't expect much. Our good folks at the Mortgage Bankers Association are expecting a 6% overall gain in dollar volume this year,
Hmm.
but then they're expecting, about 1% in the next 2 years. Um, so a 6% gain is looking pretty good, but it's down from their prediction of about an 8% gain in February. So each
Hmm.
month they revise their forecast. And this year is pretty evenly split between purchases and refis. A little less than 6% on the purchases, a little more on refis.
Okay.
And just following up there, Jim, on the research that you've completed, another thing that the research showed was that first mortgages have climbed from 19% of total originations in
Mhm.
2023. Now they've climbed up to 24% for the first quarter of this year, 2026. So is that evidence of a genuine recovery? in mortgage lending, or is it more of a reflection of weakness in other lending categories like auto loans?
Hmm.
Okay, yeah, that the total amount of first mortgage originations um, is up for the last 2 years. It's just that it's with sucky numbers 2 years ago. So if you look at it longer term, we're
Hmm.
still below the kind of range that was like 33 to 40% range from 2012 through 2022. And
Right,
so it's getting better, but it was a lot worse just a few years ago.
right, right. Okay.
And with that, that's where I want to have JC come in here. We wanted Jim to kind of set the picture a little bit again from his data and analysis of that. Does this match what you're seeing at Amplify?
It does. We definitely have seen periods of time this year where borrowers have taken advantage of refinance activity because rates have been near or at 6%. There was a week in January, another week in March, even late April. There was dips in the market where that was favorable to the borrower to do that. Now we're hovering around 6.5% at the moment for a 30-year mortgage for a fixed rate loan.
And you kind of mentioned it there a little bit with January and March. What did the purchase activity look like this spring, and how historically does that compare to other years?
It's definitely up this year compared to last year. Looking at the same period of time, the first 5 months of the year, we're definitely seeing more production. We're entering what we believe to be most lenders consider this time of year the purchase market timeframe. Where people are finishing up school, ready to look for a house. There's warmer climate, so people are more inclined to go house hunting. But it's up drastically at Amplify.
Right. Okay. Now, JC, I want to get just kind of a better picture of, who your borrowers are and where they are. Obviously, Amplify is based in Austin, Texas. So are most of your borrowers mostly we're talking about houses in the state of Texas, or are there other areas as well?
That's correct. It's all in Texas,
Right.
primarily in Central Texas.
Okay.
Amplify has an originate sell service model, and we also have a
Hmm.
third party lending channel that extends outside the state of Texas, but they have originators that send us referrals that are for Texas borrowers.
Right. Okay. So just looking at that core group in Texas, mostly in Central Texas, obviously it has its own, there's, own factors in that housing market compared to other states. How would you say that the market in Texas for housing benefits your borrowers and the credit union compared to markets where, affordability and inventory challenges are greater? Like I'm in California, obviously a different beast there.
Yeah.
How would you characterize that in Texas? Are the prices still pretty good in comparison, and how does that kind of impact, the borrowers and then also the credit union?
So we have seen home values in Texas begin to soften in the last 6 to 12 months. So the median house price in Texas, I think I last read, was around 350,000. So there is more inventory this at this point in time than there was last year. And when home prices begin to soften like that, that really creates a buyer's market. And so Texas borrowers are able to negotiate more with the seller in the sense of asking for seller concessions, contributions to closing costs. We haven't seen that in the last few years. And we're beginning to see it more and more in Austin, San Antonio, Houston. We've seen purchase contracts where closing costs are near 3% contributed by the seller. Back during the COVID-19 era where rates were at historic lows of 2.5% and 3%, we didn't see any of that. We saw quite the opposite. We saw over asking, contracts, very, very tough competition for the same house. And so it's very much a buyer's market right now.
Interesting.
I want to stick with you for a few minutes, but I'm seeing that Jim is nodding his head quite a bit, and I do want to get back to Jim. But JC, for a second here, you were talking about the rates. You're hovering around 6.5 right now. When it
Yes.
was down at 6%, what was that, a few months ago? Did you see an increase in refinance activity when it
We
was around
did.
6%, or and then what happened when it started creeping back up?
The applications began to pause. And so you
Mm,
have this locked in effect, right? Where borrowers have a rate maybe that's near 7 or over 7%, and they want out of that. It's quite the opposite than, the member that has, the 2.5 or 3% that took advantage of that a few years ago.
mhm.
So the minute that they see that there's a benefit, of a half point or even a full point, then that's when they're more motivated to do a refinance application and come out of pocket closing costs.
Right. And also on that, I believe you had said that you believe that rates would need to be at or below 6% to really encourage someone to look at their refi options. Why is that threshold so important? Why 6% and below?
I think one of the most important things a credit union can do when consulting with their member is what are they trying to achieve? Because an interest rate, well, it's a good benchmark to kind of assess what your fixed payment will be. It's very much relative to what's your reference. The house in my background is Golden Girls, and I picked that because back when that was taping, rates for a home were around 16 to 18%. Now, I know in the last,
Mhm.
45 years, everything has become more expensive. So it's just a matter of identifying like what is their objective.
Mhm.
Is it cost savings? Is it cash flow? Are they intending to stay in the home longer than 3 years so that way they can recoup what they spend to refinance the house?
Mhm.
Would they consider refinancing again if there is another drop in rates? And so I say 6% because a lot of the borrowers that we've seen refinance are about at 7 or just above it. And so they're really trying to capitalize on that interest savings. But we have those discussions with the borrowers early on so that way we understand what is it that they're trying to do. A lot of borrowers are just trying to access cash. They want to improve their home, they want to consolidate debt. And so that's when we look at the options of a home equity loan or a home equity line of credit.
I do feel like I'm going to diverge here for a second. I feel like the number 6%, just a solid six, is kind of a psychological game we're playing with ourselves, because we're afraid of seven, you know.
Right.
We'd love 5 and 3 again, but I don't know if that world's ever coming back. But do you feel like there is kind of a psychological, like, you know,
I
uh,
absolutely do. Most people that are homeowners are very careful with how they spend their money. Um, but the idea of mortgage credit, just in general, is a very powerful tool. And so if we're able to get that in the hands of more people, we believe that the generational wealth of a homeowner is 10 times greater than that of a non-homeowner. And so once they have a house, then they've achieved that part. But saving money, very much in line with most credit unions' missions to do that, to improve the financial health of its members, is what it's about. So we do have a lot of applications come in for refinance, but the minute that window closes, they continue to wait. And I think it is psychological, like you say. I do think
mm,
that people want to be at 6, lower than 6. They definitely want to be at 3, but I don't know if we'll ever see that historic low again. There was a lot of
yeah,
things at play when that happened.
right. And I do want to point out again to our audience, if you do have a question, you can please pop it into the Q&A widget or just raise your hand and I'll call on you. And I want to go back to Jim now. Again, Jim, I've been watching your face and your reaction as JC's been speaking here, completely agreeing with them, as far as what he's seeing down there. But Jim, one of the more interesting things in your reporting, and again, we'll put a link to that in this show here in a bit. But one of the more interesting themes that you uncovered is that millions of homeowners are sitting on mortgages with rates far below today's markets. Not a shock, but how much is that kind of golden handcuffs, effect still shaping housing activity right now?
Um, I think he said it perfectly well. It's affecting it a lot. And again, it's relative, like you said. Is it? I think that's the rate he was quoting was about the rate that my older brother paid for his first house in the early 80s. I can't really remember. I'm pretty sure mine was somewhere in the 6 to 7% range in 89. So 6.5% seems okay. But it's again, it's psychological, and it's not. The my I have two sets of kids in our family who are too young. Each of them have two young children,
Hmm.
and they bought a refinance shortly after the first child was born, and now these creatures are climbing the walls, and they might have wanted to move to a bigger house, but it's they're kind of held back.
Mhm.
Can I pop in? Oh my gosh, Stacey Armijo is in the audience, ladies and gentlemen.
Mm.
She is fantastic. She is also with JC's credit union down there, Amplify. But question from Stacey again. She has a great podcast. Everybody, if you ever want to listen to something great, check it out. But she is actually asking you, JC, if I could pump this in. Knowing home equity lending is an opportunity for credit unions when purchase volume is uncertain. Do you have any advice for how credit unions should pursue that opportunity and any common misperceptions we should be aware of?
Absolutely. Thank you, Stacy, for the question. One of the misconceptions that a lot of homeowners have when we begin the dialogue of exploring a home equity loan is they don't believe that they can qualify due to the length of time that they've owned their home, or they think that you have to have pristine credit, maybe similar to what they had when they first took out the loan. And that's simply untrue. We recently lowered our credit score requirements at Amplify to 620 to further expand the number of borrowers that are able to access that equity. People, are struggling today with affordability in the sense of having a lot of high interest rate debt, and they don't know that they can access their equity in their home and consolidate that debt so that way they can improve their financial position.
Mhm.
Another misconception is they don't know that they can the terms that are associated with it, or that they can have a revolving line of credit, tied to their home. And so we're often surprised by some of the questions that are asked, but we're always here to educate them and tell them, exactly what is out there. And we always encourage them to shop. Every lender has different targets with regard to what their margins are with originating a home equity loan. So that's also important to explain to the borrower what they're paying for when they take out a home equity loan,
All right.
because it's far less expensive than a purchase loan. And so sometimes there's that misconception. I have to go to a title company. I'm going to have all these third party fees. And that's simply not true.
Right. Well, thanks for that, JC, because I know the topic of affordability and just trying to help people get into a home or make their payments is no, that's a topic that hopefully we can get to it a bit more later if we don't run out of time here. But yeah, that's a good point.
Yeah.
Wanted to bring up another topic here, just on the same concept of helping the borrower, and that's the concept of helping borrowers reach that break-even point on a refinance. So when they reach the point where the refinance will actually start saving them money. What advice do you have for borrowers who, because I know there's different types of home borrowers, those that might be planning to just stay in their home temporarily and they might be moving again in a few years versus being in that home as a long-term, residence. What advice do you have for each of those groups who are trying to maximize their savings on a refinance?
Sure. So I think it's an important distinction to really understand what is the borrower trying to achieve. If it's to improve their cash flow, save money from the monthly payment that they're making, and they know they're going to remain in the home for more than 3 years, typically, that's the amount of time it typically takes to recover those costs that they're going to have by doing the refinance, the closing costs. If they took out a loan last year and rates are lower, about half a point than they were a year ago, in some cases, even a full point, depending on the product that they took out, they will get a break on title insurance, from the title company because it's been such a short amount of time. Now, if they took out their loan 3 years ago, then those costs will be closer to what it would typically cost. But the reason why it's important for someone to know um, how long they're going to remain in the home is because of the break even benefit cost analysis. They have to understand, like, what is it going to cost me to take out this new loan, and will I recover it in monthly savings in 2 to 3 years? And if the answer is yes, and I'm going to remain in the home, then it's a good financial decision. If the answer is no, then they're better off maybe refinancing an auto loan, maybe consolidating some debt from by using a home equity loan, if they know they're going to be leaving that house in 1 to 3 years. Typically, most borrowers know, if they're going to have changes in their life, maybe start a family, maybe relocate for a job. Those are things that they've already considered, and sometimes they're not aware. They just see a lower rate and they say, let's take advantage, and then they pay about 2 to 4% of their loan amount, and then they don't recover that. So that's not a good move.
I was thinking about something. You've given a lot of historical context, JC, around some of the answers here, and I was just thinking, what are our guesses that the rates would be on the loans when we closed on these houses that are in our background? Like you had mentioned, JC, the Golden Girls house would have been what?
Probably 18%
18?
back when this house was built. Mm-hmm.
Because I'm going to guess this in 1970s, Amityville horror. I'm going to guess, yeah, 18, 19% maybe back then. I don't know. What do
It
you
was
think, JC,
it
Natasha
was
or Jim's would be?
it was less in the late 80s. It was after the second oil embargo, and so it was like 1980,
Oh, okay.
Carter's administration, which my brother would have pointed out.
Oh, sure. Yeah.
Yeah, and I'm not sure
What do
what
we think
year
Natasha's would have been?
this house was built. I mean, I'm guessing 80s, just looking at the style. Um,
Sure. So maybe it's
so
lower.
would be lower, yeah.
I think that's a
Um,
fun little conversation. But if anybody has a guess or knows what these houses would have gone for at the time, that I'd love to know.
oh no,
Um, what do you have,
no,
Natasha? Yeah.
72. It was built in 72, so it
Oh,
looks like it'd be more
72.
in that higher range,
That's tough. No wonder you had to cook meth to afford
right?
that. Just kidding. I think that's the first time we've said meth on this program.
Probably.
Okay, that's my segue to Jim. Jim, I got a question for you about HELOCs.
Okay.
That's been an interesting development in recent months and the last couple of years. HELOCs and other second liens, I'm looking at the data. They have grown from 16% of residential loans in 2022 to 23% today. What the heck is driving that shift? And what is
I
that
think
telling us?
I think again, JC just explained it. A lot of times a refinance does not make economic sense, especially if the rates aren't moving that much. Um, and so it's a lot cheaper to get a HELOC and to pay for things, and that's and then the prices have been going up. So if you got that 3% loan back in 2000, 2001, and your home value's been going up, you've seen prices in the neighborhood going up. Um, you can tap into that and you can do the home renovation. You can help finance a car. You can have a baby, maybe.
Maybe.
We'll get to that hopefully later with the
That's a
declining birth
different
rate and
webcast, I think, right? Yeah.
Yes.
how that's affecting the housing market, the declining birth rate. But we'll see if we
Sure.
have time. We'll get to that a little later. I
Okay,
think that's
we'll see.
interesting.
I agree. I
Um,
agree.
so then, okay, so still on HELOCs, JC, what does the HELOC activity look like for Amplify so far this year? Does this seem to match what the data show nationally?
It does. We're not quite at 20%, 23%. We're closer to 15%. But what is really interesting about what we've seen the first 6 months of this year compared to last year is that more borrowers are utilizing their HELOC at closing than they did last year with regard to knowing what they want to do with the funds. So we've kind of gotten away from borrowers just taking out a HELOC as a safety net. We saw a lot of that
Mm,
during the liquidity crisis, where there was a lot of people that had some uncertainty with how the economy was going to go. Now what we're seeing is someone wants to put in a pool or they want to consolidate debt. They know right away what it is they're going to use it for. So the utilization of those HELOCs the first 6 months of this year is about 35% compared to 20% last year. But
wow.
the trend is pretty close to what Jim is talking about.
Okay.
With the rates staying where they are right now, above 6%, and everyday costs, like you've pointed out, we pointed out on other conversations and podcasts, just how expensive everything is this year, especially. How is Amplify, your credit union, helping members achieve kind of first-time home ownership and assisting borrowers who might be struggling with their mortgage payments right now? And I know those are kind of two different worlds, but
Sure. No, we take affordability for homeownership very seriously here at Amplify, and we actually created a first-time homebuyers loan program last year. And so it allows for 100% financing for a mortgage with no private mortgage insurance to pay monthly. And what we had found is that a lot of borrowers that were applying for loans and trying to get pre-qualified either had the down payment or they had enough money saved for the closing costs, but they didn't have both.
yeah,
And these would be members that didn't have someone to lean on for a gift or didn't have, the resources aside from their retirement account that we wouldn't want them to touch to come up with those, down payment and closing cost proceeds. And so we have been able to help more members that are home ready get into a loan and but by virtue of that first time home buyer program. We also have doctors. We have a doctor program that we introduced in the last 6 months, whereby a medical doctor or a professional individual that has, that has a license or certification, maybe a nurse
hmm,
practitioner or CPA, they can also get financing that is different from what we would consider a conforming, standard. So they can also get 100% or 95% financing without the need of private mortgage insurance. And that helps with affordability. When you're not
yeah.
having to pay that incremental insurance every month, that really benefits only the lender. As it relates to borrowers that have mortgages today,
Hmm.
we have very low delinquency at Amplify. Um, we service a book of business of about 1.5 billion for 150 different participant investors, and that delinquency is 0.34%. So basically rounds to zero. But when we do have a borrower or a member that is struggling financially, we
Hmm.
will come up with a solution that benefits them. We give them time to get back on their feet. If they're experiencing job loss or illness, or if there's been a death in the household, we definitely work with every borrower. And I'm really proud to say that during COVID-19, we didn't have any foreclosures. We were able to assist everyone that applied for
Yeah.
forbearance or deferment. And they continued to perform after, they were able to get past that period of time.
Can I ask two quick follow-ups here? One for Jim. Jim, or well, let me ask JC. You said 0.34% was the
Mhm.
delinquency? Okay.
Mhm.
Jim, is that how does that compare? I don't have that in front of me. Do you
I
know
don't
off the
either,
top of
but
your...
that sounds about right. I mean,
Okay.
this I've I covered the housing crisis back in the aughts, and you know that was delinquencies obviously were rising as with the foreclosures, et cetera. And neighborhoods would is a big deal, but that has not been an issue. That's good equity on these loans, so it helps credit unions be able to reach out and lend to a broader segment because
Yeah.
that their assets are solid.
And thanks for Jim. But JC, again, a follow-up question here on the doctor program.
Mhm.
Why that? Where did that idea come from? And how are you pulling that off?
Sure. So just this is my 29th year in banking, and I have seen other institutions have great success with a doctor loan program. You're
Okay.
talking about an individual that has been in school 8 to 12 years. They're carrying debt associated with that, and so they're stretching every dollar already. And so then to then ask them, can you come up with 3, 5, 10, 20% to do this loan, as well as closing costs, for their first home? That's almost impossible. And with the cost of everything else today, this is just a benefit to them for taking on that type of professional position and helping them get into their first home.
And it's actually a plot point on The Pit, if you guys watch that show.
That's a great show.
It's a great show. Anyway.
Okay. Well, no, Michael, I was going to ask that same question. So thanks
Okay.
for that, JC, and thanks for clarifying the concept of, they have taken out a lot of loans for their schooling. Because my first thought was, well, what does that say about our world where a doctor can't afford to buy a house? That's, if you look at it that way, it used to be where you could just work at Sears and you could support a whole family on a single income, right? And buy a house. But yeah, no, that's really interesting. But yeah, that makes a lot of sense, obviously, with the debt they're carrying through schooling and all that. Wanted to get a little bit more into just the members, helping the member, and I love this part of the conversation. How important, JC, would you say it is to deliver a really high quality experience for the member? How important is that to the health of your mortgage portfolio at Amplify? And what does that look like? What does the borrowing or even refinancing experience look like for members at Amplify? I'm sure it can be an intimidating process for people, who have never done it before. So tell us a little bit about how you make that experience, smooth and friction-free and helpful.
Absolutely. I can't overstate how important that is to our business. We rely on our members to sing our praises with regard to how the experience was. Because oftentimes they're working with the realtor, if they purchased the home or they're refinancing, they might tell their neighbor, their friend, like what a great experience it was. So it's very much about relationships in this business. We're working in a commoditized business, and so they can essentially go anywhere. Especially with some of these larger players like Rocket Mortgage, and other larger banks that maybe don't have that have much more marketing dollars to just kind of see every day, like on TV and on the internet. And so we very much rely on making sure that the experience is a great one. We do member satisfaction surveys at the end of each closing so we can learn what we did right, where maybe there may have been a misstep, and uh, almost always we get near a 5 score, which is perfect. And so we really rely on making sure that they understand that we're not only here for their mortgage, but if they're in the market for a car now or maybe later, or if maybe they have some CDs that we see on their application with regard to their assets, we at least let them know that this is a place that they could also invest money that way, because they don't often know that we have those other services.
Yes, yeah, okay. Wanted to branch out a little bit more to just other areas of lending. Obviously, we're talking about mortgages, but I know you're the chief lending officer, so obviously you're involved in other areas of lending as well. Curious, how would you characterize like the relationship between the mortgage lending area specifically and then other key areas of the credit union? So I guess not just other types of loans. I was thinking of auto loans as well, but then there's also other areas like deposits, member growth, member retention. When you look at other areas of the credit union, either other areas of lending or other areas of business altogether, what happens to other areas when mortgage activity is particularly strong or weak? Is there like a relation or patterns, I guess, that you see, if that makes sense?
Absolutely. The success that we've had over the last 12 months is due in large part across, for organization wide efforts. It's not been done solely by any one area of lending. It has required, the work of everyone across Amplify Credit Union. And what I mean by that is we've implemented a lot of process efficiencies over the last 12 months that have allowed us to be able to do more volume with the same amount of people that we've had, the last 12 months. And so when we have a borrower that is applying for a jumbo loan, let's say, and owns, 6 different businesses, we will mention to them that we have that we pride ourselves on being a retail fee-free banking institution where it is impossible to earn a fee on the retail banking side of the house at Amplify. Wires are free. There's no minimum amount. There's no checking fees. It's impossible. And so we've really tried to leverage that relationship with our borrowers and let them know that they can do commercial banking with us for free. If they're looking for investment properties, or if they're looking to invest in an apartment complex or a commercial loan, then we will, hand that off to a commercial lender at Amplify to be able to assist. If they're looking at, competitive certificate of deposit rates, or if they have a market money account at Chase or Bank of America, we will tell them, during the time that they're applying with us, what our rates are, so that way they have a full picture. And so I think that goes a long way. I don't believe that people necessarily have a primary financial institution. We live in an age of technology where banking can be done by your phone. You can compare, 10 different lenders, especially now with the invention of AI. It can tell you, who's the best out there. And we've even gotten referrals from ChatGPT just based on member experience, just based on some of our commercial borrowers that had a good experience, looking to us for financing, for an apartment complex development or something of that nature. And the same goes with consumer lending. There are times where we see that a borrower has several different autos that haven't been financed and haven't been refinanced in some time, or maybe they took out a pool loan or they took out a solar panel loan, and we can tell them you can borrow against the equity in your home and get those resolved and pay much lower rates than what you took out, because that's essentially an unsecured credit and they're paying unfavorable terms. We have seen our deposits on the consumer side grow in relation to some of the loans that we've done for our jumbo mortgage borrowers, that have significant assets that they then put in Amplify. And so I think it's just a matter of discussing, those things with those borrowers so that they are aware that exists. One point I will make is, growing up, my father was a high school teacher for 40 years, and my mom was in banking. And I was always confused as a kid because we never went to the bank, for any loan that we needed, an auto loan. We took out a loan when I got braces. I always just thought it was really interesting that we never went to her bank. We always went to the teachers' credit union, and it was because their rates were more favorable. And that still holds true today. Now, we've become much more competitive over the years. Credit unions are able to compete with banks on a different scale than they were back when I was, much younger. But I think that that's important, that we take the time with our members and we explain the full suite of things that we can do, because you don't think about a credit union when you're running a commercial business. And so we've really leveraged that this year, and we've had great success due in large part to Stacy, promoting that piece of the business. And so we're well ahead of budget with regard to the commercial banking deposits that we've seen. And it's back and forth. We work with our product management teams and our IT teams to make sure that we can get technology updated quickly, so that way we can continue to improve our efficiencies.
Yeah, if nobody has met or worked with Stacy before, reach out to her. She is an incredible, not only human, but credit union advocate, for you all. She truly has been a wonderful person since I've known her and working with her, and she has all sorts of data that's really incredible, that she collects from Amplify. A couple of follow-up questions, because we're about out of time. We only have a few questions left, but I wanted to ask JC really quick. What bank did your mom work at?
She worked at San Pedro Bank and Trust in San Pedro, Texas. I am a product of the Rio Grande Valley in South Texas.
And where did your dad teach?
He taught at San Pedro High School.
Okay.
This is
Was that the name of the credit union?
No, the Teachers Credit Union was Harlingen Teachers Credit Union. They've now renamed themselves in their RGV Credit Union.
Okay. I just wanted to call those out. So God
I
bless your mom
appreciate
and dad. That's
it. Thank you
cool.
very much.
Yeah, of course. Jim, question for you, or sorry, JC, I have one more question for you. What are you anticipating purchase and refinancing activity to look like for the second half of this year?
So as we know, this is a very volatile business. The market is going to do what it's going to do. There are a lot of economists now saying that we can expect 1 to 3 interest rate hikes before the end of the year. So it's kind of a mixed bag. I'll believe it when I see it. We've had so much success in the last 12 months that I do think that the refinance activity, the purchase activity will continue. I do think that people have kind of overcome the 6% rate. You mentioned, Michael, that was the rate that you had when you bought your first home. It was also my first rate when I bought my first home in 2006. And so I think people will continue to buy and refinance, even if rates remain in the sixes. Now, if they cross 7, we're going to get back to the whole psychological, impact of what that means. But there are other solutions. There's, 5/6 and 7/6 hybrid, adjustable rate mortgages that we've had success with some of our borrowers, and so that also kind of helps you remain in the fives, if that's what you're wanting. And if you're only going to be in the house for 5 years, or that you'd be willing to refinance when rates come down, then that's also a great product.
Okay.
Yes. Okay, so we wanted to wrap up with a few more questions for Jim, just to close us out here. If we can, I'd like to go back to that topic I briefly mentioned about the declining birth rate with declining population. You had a really interesting story, Jim, that we published yesterday. It was some new findings from the Mortgage Bankers Association concerning
Mhm.
how declining population growth might impact the future housing market. Can you just summarize kind of the main takeaways from that report for us?
Yeah, I mean, we talk about rates, and rates can go up and down, et cetera, and the economy can do whatever. But they sort of looked back and said, what could under the main factor that drives mortgage originations is household formation. So they're looking at a the younger generation having babies at a lower rate, declining rate. Um, Old folks like me and the big boomer generation, which is so much of the population, we're going to be dying at a faster rate. And then there's immigration, in which, you know, um, whatever else you may think, whether you think they eat cats. Economists will tell you healthy immigration growth is good for the economy and around the world. So
Yeah.
it's and that's declining. So that's not good. And that's the backdrop for the next 10 years, 20
Well,
years.
in today's decision by the Supreme Court didn't help, with the immigration issue. Just to be blunt about it, as far as, kind of the point we're making right here,
Mhm.
for the market. Jim and JC, just kind of one final question as we wrap it up. Jim, what are you keeping your eyes on for the rest of the year in this market? What's
I have
your
a
what's
limited
your like,
imagination.
yeah,
Rates,
rates? Okay.
rates. Yeah, could concentrate on babies, but
That's a
it
weird
doesn't
sentence.
doesn't do
Okay.
doesn't do much for the for our copy. Um, got grandchildren.
Yeah, yeah.
The but yeah, rates. I mean,
Going, yeah.
for the rest of the year, but I think it's looks like there's not going to be much to watch.
Maybe. JC, what about you?
It's interesting that you mentioned that fact about growing families and the birth rate being so far down. My husband and I have 15 nieces and nephews, and none of them are
Yeah.
interested in having kids.
Yeah.
And I just think it's a sign of the times.
Yeah.
But it's also, we have a third party lending channel here at Amplify that
Mhm.
allows us to, extend our reach. It acts as a force multiplier because it's that many mortgage loan officers that we have access to sending us leads. And so our focus is going to continue to build out that network. We have 34 brokers now. We would really like to be at 100 by the end of the year. And what that allows us to do is originate more loans and then sell them to credit unions as participations. And so we actually got a really great compliment yesterday from one of our investors, and they're a 235 million asset size credit union here in Austin. And they buy a lot of our loans, because they don't have that kind of operation where they can do some of the loan products that we have. And that just goes to further, the importance of being able to diversify other credit unions' balance sheets. And so by continuing our focus with the brokers, we can continue to do that.
That's a great point. With that, I am going to wrap it up, but I want to ask one more follow up with you, JC. Just the fact that your mom was in banking is, and you're now a chief lending officer, you know, uh, how cool is that for your family and your mom kind of going, look at my boy, you know?
Yeah, they are extremely proud. One of the things I remember as a kid visiting my mom at the bank, she was a bookkeeping supervisor for San Pedro Bank and Trust, was there was never anyone that looked like me on the wall. Like all of the different chief executives of the bank, all pretty much looked similar, but there was really no one that looked like me or my mom.
Yeah.
And so to be able to achieve this is definitely a milestone in my career. And my parents are extremely proud. So I appreciate that question very much.
I love those stories.
Incredible. Love.
Yeah, we with that we are out of time. We got to let JC go. But thank you so much, Natasha. I'm glad you were able to join us today. Jim, as always, great seeing your noggin out in South Carolina, and of course, JC San Pedro, Chief Lending Officer at Amplify Credit Union in Austin, Texas. I do think you all should create a loan just to buy tacos because
There we
I
go.
would do that. It was great having you here. Thank you so much.
It was my
And
honor. Thank you so much, everyone.
I appreciate it. Give Stacy our
Really
best.
appreciate it. Yeah.
But to our audience, thanks for coming on. And Stacy, she was on earlier. Thanks for your questions and supporting CU Times Pro. We really appreciate it. This whole show is going to be up online here in a bit, and I will send that out to you all. But for now, really, next week, have a fun and safe holiday week. But no matter what people say, do not drink a beer for each year that we've been an independent country. It won't turn out well. But anyway, have fun. Take care of each other. We'll see you all next time. Thank you all.
Thanks,
Thank
everyone.
you.
Bye. Take care.
Bye-bye.